meeting also on 15th March 2023. SEBI has approved various amendments in ICDR, LODR, AIF regulation in order to facilitate ease of doing business. One landmark development which is proposed in this meeting they have done, launch of that the draft version of optional T+0 settlement scheme, which I will explain to you. The amendment in ICDR including facilitating companies coming for IPO and fundraising. The amendments in LODR include changes in determination of market capitalization, extending timeline to filling a vacancy of KMPs, harmonization and reduction in timelines for prior intimation of board meetings, and increasing the maximum permitted time gap between meetings of risk management committee. A uniform approach of verification of market rumors has also been facilitated. There is also proposal which is approved by the board to provide additional liquidation period to schemes of AIF to deal with unliquidated investment with expired liquidation period. That is also a direction for ease of doing business. And you are aware that SEBI has formed a committee, industry committee, the Indian Industry Standard Forum, and that forum is chaired by Mr. Kamath, and that committee is taking so many decisions relating to rumor verification and other aspects of market capitalization, which is a part of rumor verification, because what should be the which company can come into this, whether it's a pure 31st March market capitalization you will take, or it's a regular. So they have changed this also. The objective of webinar is to discuss and deliberate the proposed amendment by our expert panel. And I extend a very hearty welcome to our learned speakers for today's webinar. Ms. Anjali Agrawal, Ravi Prakash. Anjali is a partner in capital market services, corporate professional. Mr. Ravi Prakash, associate partner, security law and corporate litigation. And they both will deliberate on this subject. And I will cover the interesting part of this T0 settlement. And friends, as you are aware that we are doing webinar every Friday, except some pressing holidays in between on the Friday. So the journey which we have started long back will continue. And in our next webinar, that is 160th webinar on small and medium REITs, we will organize on 12th April. And recently, SEBI had notified the regulation of governing small and medium real estate investment trusts, that is called SM REIT, of income generating and completed properties, which may include commercial assets, renting house, warehousing, and hotels, amongst others. The introduction of regulation is set to enhance investors' trust, broadening the embrace of the growing asset category. This effort is expected to offer vital backing of real estate developers, creating an extra opportunity to capitalize on asset and inject essential liquidity into the market and industry. So friends, this is our next webinar. We are informing in the beginning, so everybody can understand and participate. Now, the program which we are organizing today, the structure is that first I will cover T0 settlement. Then Anjali Agrawal will cover ICDR regulation, LODR regulation, AIF regulation, and InvIT regulation. What are the changes suggested? And then Ravi Prakash will cover FPI regulation. And after that, we will have a question answer session. So anybody has any query on these topics, they can write to us. So friends, the most important development which has taken place, Ravi, Shivam, can you just, yeah. So the most important development has taken place, that is the landmark T+0 settlement. Now, SEBI-wide circular dated 7th September 2021 allowed for introduction of T+1 rolling settlement cycle. All stock exchange, clearing corporation, depository market infrastructure institution jointly decided to shift T+1 settlement in phased manner, which was fully implemented with effect from 27 January 2023. Now, SEBI-wide circular dated 21st March 2024 has decided to put in place a framework for introduction of the beta version of T+0, that is a same-day delivery and payment settlement cycle on optional basis, in addition to the existing T+1 settlement cycle in equity cash market for limited set of 25 scrip and with a limited number of brokers with effect from 28th March. So 27th, the SEBI has given the green signal, and 28th March, this will start. So SEBI has issued the notification on this. Now, introduction of this beta version of optional T+0, two things we have to understand. One is all investors can participate. They have to able to meet the timelines, process, and risk requirement as prescribed by the market infrastructure institution, that is stock exchange and clearing corporation, and other people connected to this. The surveillance measure is that applicable in T+1 settlement cycle shall be applicable on the scrip of T+0 settlement cycle. Timing is not up to 3:30, it is 9:15 to 1:30 p.m. Now, friends, you have to just see this. It is only because they are providing, but they are coming out with some changes. They are only 25 script, and that is also limited broker. Now, in operational guideline, there is a price band. The price is T+0 settle segment will operate with the price band of plus minus 100 basic points from the price in the regular T1. So there's no change in this. The band will be recalibrated after 50 basic point movement in the underlying T+1 market. Now, index calculation and settlement price computation, that also everybody should understand, because when you do trade, then the settlement and the index calculation will be different. So T+0 price will not be considered in index calculation and settlement price computation. So that is going ahead with the T+1. There shall be no separate closing price for securities based on trading plus T+0 segment. Two aspects is there. One is it will close at 130, number one, and other market T+1 will continue to 330. So that's why they are not taking this price, and this price and that price will have difference. That is another issue which will come, and automatically market will slowly adapt it. Then netting of obligation, no netting in pay-in and payout obligation or between T1 and T0 settlement cycle. So suppose you are purchasing some share in T1 and some share, or you are selling in T0, it cannot be net off. So both are, you have to treat as a separate stock exchange, separate system, and you have to trade accordingly. Next is the introduction of this settlement. What should be the strategy for stock exchange and market intermediaries? Number one, position the exchange is more innovative and attractive for investors seeking faster transactions. So first thing will take place, because today you are buying and today you will get delivery. Today you are selling and you will get money. So that is one advantage. So T+0 is an advantage. T+1 is trading and then +1. So whatever you are doing trading today, you will get delivery and payment next day. So this position will change and it will give a new dimension. An exchange has to ensure that system and process can seamlessly handle this increased speed without compromising security and accuracy and simultaneity. They have to have a two cash segment. One is this segment of T+0 and T+1. Now, what are the stock exchanges and intermediaries, stock exchange and market people should do this? They have to create a stock exchange with dynamic risk management tool, because here buying and selling on the same day. So the risk management, which is there open for one day, it will change. Circuit breaker and trading halts will also be they have to take care, because it is not only one, they have to take care of both. Then enhanced market surveillance has to take place, because some people should not manipulate this particular thing. Educating market participant, that is also important. All these points which I have told you, they have to communicate. So people should not confuse that I am buying here, selling there. It can be set off. Robust liquidity provisions, because market will be more liquid. So they have to take care of this part. And then strengthen settlement and clearing process, because the most important thing is today you are buying a same day settlement and payment is taking place. So you should have in place the banking, the depository and the stock exchange, clearing corporation, all should in tandem, and they should do this. Next is the strategy with the stock exchange. Now coming to the next part, that is a broker. So Shivam, change the slide. So in the broker, because they are the people who will trade on behalf of investors, on behalf of their own. So they have to see the real-time processing system should be there. Enhanced risk management tool should also be there, because they are also having, no doubt, they are giving it to limited broker. But after some time, after the successful of this, other people has to follow. So the risk management tool should also be there. Automatic compliance and reporting, because in T+1, you have a evening time when you report. Here you have to automated compliance and reporting system, because you have to report in the evening when the transaction is completed, buy and sell both. So their system should be automated, whatever the stock exchange subscribe or suggested. Cyber security enhancement, that is always there whenever you are doing any systematic transaction. Interoperability with other system, because the transaction which you are doing, and because you have now T+0, T+1, you have an option future market, another market. So you have to shift and replace this. So this is another issue which will, no doubt, by doing this, the broker might experience the trading volume will go up and liquidity will enhance. So when the liquidity will enhance, so people will buy and sell more and reduce credit and counterparty risk, because transaction will take place. There's no open position in this. That is also. Next slide. Now, the most important, if you remember, when this issue was coming, the foreign portfolio investor was opposing this, because they were there's the other part of the jurisdiction also. There's no system of T+2. They are having a T+1, T+2, or they are having a outright system. It still persists in other part of the jurisdiction. So FI might find market with T+1 more appealing due to quicker access to their fund and investment potential, increase their participation. That is one part. But they have to align their trading and risk management strategy with a faster settlement cycle, which they are not, because other part, everywhere, it is a T+1, T+2. So they have to modify this. Today they are buying and tomorrow they want to sell. So here, whatever you are buying and whatever you are selling, you have to pay and take delivery immediately. Next. So now what are the advantages of the T+0 settlement? The increase in transaction, number one, when you can buy and sell. So you have an opportunity. So immediately you can enhance your transactions. Second is improve liquidity. No doubt, when the transaction will go up, the liquidity will also more and more turnover will take place. So liquidity will go up. Increase in turnover and reduction in impact cost. Whenever there is a liquidity improvement, then the turnover is going up. Then the impact cost. The impact cost means that suppose you are going to buy something and you are selling something. So the difference between buying and selling price called the cost between both, that is called the impact cost. So whenever the liquidity is more, then the investor will always get, suppose some share price is 276.10 paisa, and then this is the buying, this is the selling price. The buying price will be 276.9 paisa. So whatever this gap will be less, it is good for the investor, and they will not sell at a higher cost or buy at a higher cost and sell at a lower cost. then increase trading opportunity when people will do this, so they can buy from other script, other type of trading they can do because they have a fund. Next. Then market efficiency of market will increase because you are finding that more and more people will join, more and more investor will come, and you have to have your system on toes, and improved system should be there. Lower settlement risk, that is also because buy and sale is taking place. Lower settlement is suddenly the market in the evening came to know that some war has taken place, so market will go down. So next is you have purchased something and you want to sell something, and then the market has gone down drastically. So here, whatever you are buying and selling, lower settlements risk is always there because we have no open position. Removal of auction system, that is another aspect will take place, because wherever you are buying something and the delivery which you are expecting is not received fully, so that system is going for auction. Here, that auction system will not be there. If you have a shares, then you can sell. If you have a money, then you can buy. Reduction in no default in pay and payout, because here you cannot have an open position. So whatever money you have today or just now, accordingly transaction will take place. So inclusion of new investor, by doing this, investor will feel that I have a more liquidity and they can buy and sell immediately, and they can come in the market, because they are not coming to the market because they realize that market, I'm buying this and money will come after 2-3 days. So they are a little bit confused. So that's why they don't want to do this. Next. Now understand the disadvantage of T10 or T0 settlement. Operational challenge. There will be operation challenge will be there, because at present will be more T+1, T+0, both are there. So that is one part. Potential for increased volatility, because more and more people will come, buy and sell will take place. So there is a possibility the market will have more volatile. I have more money, I can do this. Now here, you cannot, today you buy something and tomorrow you are thinking I will sell tomorrow. So you have that opportunity to hold your decision. Here you are buying and selling immediately. So quick decision is taking place. Then regulatory and compliances hurdle. That is also there, because you have to quickly report, you have to do this. So compliance issue will there. But all these things, there's advantage which I'm saying, it is initial. When system people will understand, then all these things will be reduced drastically. Now the point is, important point comes, whether this same day settlement is popular in other place or available. So when I did the research, then I find that T+0 settlement globally is only in China, and Shanghai Stock Exchange and Shenzhen Stock Exchange, they have provision of T+0 settlement for day traders in certain securities. So you can understand they are doing testing. India is also doing testing, but India has an intention to do this for all script. So you can realize this, that this system is nowhere, and India is pioneer in this. And we are saying that we should be Vishwaguru. So we are having this part, and I'm finding that India innovating in so many things. So this is one. And then I searched this T+0 settlement globally is blockchain and DTL. That's a distributed ledger technology that is there, when cryptocurrency and other things are there, where you can find some new platform exchange leveraging blockchain and distributed ledger technology have experiment with or implemented near real-time settlement and majority in the system of cryptocurrency. So friends, this is the new system T+0, which is the SEBI has started, and I hope that this system will go along and we will be pioneer in the world. Now, I will request Anjali to take up other part of ICDR changes, LODR changes, AIF and InBid changes. Over to you, Anjali.
Good afternoon, friends. First of all, thank you so much, sir, for elaborating this T+0 thing so such a detailed and lucid manner. Otherwise, many of the things were really not clear to us. Thank you so much. Now coming to the amendments in the ICDR regulations, friends, most of the decisions taken by SEBI at its last board meeting are really a big step towards the ease of doing business, and they are most of them are a win-win situation for the corporates as well as for the investors. So if we talk about the fundraising process for IPOs or fundraising, first of all, what they have decided is to do away with the requirement of 1% security deposit for public issues and rights issues. For any public issue or rights issue, a company has to deposit 1% of the issue size as as a deposit with the stock exchanges, with the designated exchange, which is released after the issue is completed and the entire process, almost 3 months after the issues period issue is closed. So we need to understand why this 1% security deposit requirement came in, and now why the requirement of doing away with this particular thing. So this security deposit has been there since erstwhile DIP guidelines were there, which was DIP guidelines 2000. So during those days, the mechanisms were not so advanced, the system was not so advanced, and there were many cases wherein the people were not getting their money refunded on time, they were not getting their securities on time. But now, with the advancement in the technology, every system is in place. The subscription is made by the investors by way of ASBA, as a result of which the monies are released only upon allotment of to a particular person. So 1% security deposit presently in the present scenario is not required, and everything is so automated that this security deposit can be done away with. However, there is another thought to it, that maybe this 1% can be reduced, seeing the issue size that is coming these days. Earlier, in the 2000s, the issue size used to be very, very small as compared to the normal 700, 800 crore IPOs. So this 1% may be reduced to lesser percentage with a maximum capping of say 25 lakh rupees types, so that this acts as a deterrent, and as a so that companies as well, all the intermediaries involved can decide upon as to they have to perform in a very diligent manner. But I am in for this requirement. Now, there is the next important provision which has been brought in is with regard to the minimum promoters contribution. As per the ICDR regulation, there has to be a minimum 20% minimum promoters contribution. And in cases wherein the promoters holding post issue is less than 20%, presently the entities like AIFs, venture capital funds, commercial banks, insurance companies are permitted to be counted towards the minimum promoters contribution without being identified as promoters. In addition to these 4 5 categories of people, now they have also they have decided that non-individual shareholders holding more than 5% of the post offer equity capital will also be allowed towards the promoter's contribution without being identified as a promoter. So what is the advantage of this? This will be most beneficial for the new age SME, new age IPOs, new age tech IPOs, and the startups that are coming with IPOs, because these entities generally have done various rounds of investments, and by virtue of these, the promoters holding in these companies generally is not even to the tune of 20%. So all these entities being contributed towards the promoters contribution without being classified as a promoter will be a give a boost to the investments being raised by these entities by way of IPOs. Shiva, next. Yeah. The next amendment, which has been approved in line with the minimum promoters contribution only, is the equity shares that are arising out of conversion of compulsorily convertible securities, which have been held for a period of more than 1 year at the time of filing DRHP, they'll also be contributed towards the minimum promoters contribution. Again, the purpose of this amendment is that most of the investors who invest in the startups or new age companies, they invest in the form of convertible securities. So these convertible securities, equity arising out of it will also be contributed to account, counted towards the promoter's contribution. Now, the next amendment is with regard to the offer for sale. It talks about refiling of offer for sale, that it can be either on in terms of rupees or in terms of number of shares. Now, one would feel that what exactly is it? So, when we file the DRHPs with SEBI, so we generally do it with placeholders. Either we give the issue size or we give the number of shares. Generally, it's not, both the things are not given. So if a particular DRHP has been filed with issue size in terms of rupees, only the amendment or refiling is permissible with amendment in rupees only. And while on the other hand, if the DRHP had been filed with the number of shares, the refiling of the same will be allowed only with regard to the increase or decrease in the number of shares. Under the erstwhile law, there is a provision of extension of the issue period by 3 days under the force majeure events. But now it has been decided that it will be only for 1 day. This is again a very welcome step, that anybody who is investing with the thought that my shares will be listed on T+3 day, which is the norm. And if the company extends the issue date by another 3 days, then that means the listing is getting extended, and accordingly the liquidation of his investment is also getting extended. So extension is possible only for 1 day. Some of the important amendments which have been approved by the regulator under the LODR regulations. Now, market capitalization. As we all know, there are many provisions under the listing regulations which are applicable based on the market capitalization as on which are needed to be calculated as on 31st March of the preceding year. So many a times companies were complaining, companies were saying that as on 1st April, if I have to appoint an independent director, if I fall within the ambit of, say, top 1000 or top 2000, I have to appoint one additional director. How to get a new director all of a sudden on 1st April? So that is why SEBI has decided that instead of 31st March, the market capitalization figure would be calculated as on 31st December. And that too, it will not be based on a particular day's market capitalization. It will be a 6-month average ending 31st December, so that the companies are well in a good position to analyze and assess that a particular requirement of having 6 directors, say, on the board would be applicable or may become applicable, and they can accordingly do that calculation and those arrangements. Likewise, there is a clause under the listing regulation which says that any provision which has become applicable on a company on the basis of market capitalization will continue to remain applicable on that entity, even if the company falls outside the top 1000, 2000 arena. But now SEBI has decided to bring in a sunset clause for wherein if a particular company remains out of the market cap calculation for a period of 3 years, the particular provision may become inapplicable to that entity. This was being talked about for a very long time. There are many companies, say government companies or PSUs, wherein appointment of any KMP requires the approval from their respective ministries or any of the statutory authorities. And 3 months was being felt as a short period to be able to get those approvals. So it has been decided that this 3 months will be extended to 6 months only in cases wherein approvals are required from the statutory authorities for appointment of a KMP. Under Regulation 29, presently there are various timelines for advance intimations to be given to the exchanges. There is a provision of 2 working days, there is a provision of 5 days, there is a provision for 11 days. Now it has been decided to harmonize and reduce this timeline to 2 working days across all cases, which is a very, very welcome step from the perspective of the compliance officer who are working in in a listed entity. With regard to risk management committees, there is presently it is the risk management committee is applicable on top 1,000 companies, again on the basis of market capitalization. And as per the present law, there have to be at least two RMC meetings in in a financial year, and the gap between two RMCs cannot exceed 180 days. So it has been decided to extend this 180 day to 210 days so that the companies can accordingly schedule their meetings. But if you ask my personal view, I'm of the view that in the present scenario, wherein so many types of different types of risks are arising on almost a daily basis for one entity or the other. Sometimes it's cyber attacks, sometimes it's any of the AI things related things. I feel that there should be two meetings. The gap between two meetings should not be more than 180 days. But uh, having said that, SEBI has approved the decision to increase this gap of 180 to 210 days. Rumor verification is being talked about a lot. That's the buzzword these days. So these have to become applicable for top 100 companies with effect from 1st June and for top 250 companies with effect from 31st of December. However, it has been decided that a uniform approach and the objective criteria for rumor verification will be developed, on the basis of which the parameters will be set. Uh, then there are certain transactions wherein the pricing methodologies have been prescribed by SEBI. For example, preferential issue, delisting regulations, or takeover offers. So, in cases wherein the pricing methodology has been prescribed by SEBI, it has been decided to utilize the unaffected price for such transactions if the rumors are confirmed within 24 hours of the significant price. Sorry. Next. Further, it has also been decided that prompt responses from the KMPs, being the promoters, directors, KMP, or SMPs, will be needed to verify the market rumors. A very, very important clarification which has been given by SEBI is that any unverified information which is there in the media, be it print media or online media, will not constitute a generally available information as per the SEBI insider trading regulations. Nobody can take a plea that this particular information was there in XYZ newspaper or XYZ site, and accordingly we thought it to be information which is generally available with the public and we did the trading. That will not be the case. So one has to be very, very cautious and careful about this aspect. Uh, with regard to high value debt listed entities, there is a requirement that is going on for compliance with regard to the CG norms, which are contained in Regulation 16 to 27 of LODR. The last date for it, the effective date was 31st of March 2024, which has been extended to 31st March 2025. Uh, Now, a question may arise that what exactly is a high value debt listed company? A high value debt listed company is a company whose debt securities are listed with the exchanges uh, and to the value of more than 500 crores. Now, some of the very important amendments which have been made in the AIF regulations, with the very premise that there should be ease of funding as well, uh, will be taken up. First of all, category 1 and 2 AIFs have been permitted to create encumbrance on the equity of their investee companies in the infrastructure sector. So, as per the present AIF regulations, while category 3 AIFs are permitted to do the borrowing and leverage up to the limits which have been prescribed therein, but category 1 and 2 are not permitted. But it has been decided that if 1 and 2 are investing in infra companies which are engaged in development and operation of projects which are listed in the harmonized master list of infrastructure, they will be allowed to encumber the equity uh, that they have taken up by virtue of investment in these companies. Now, what will be the benefit of this? So, these infra companies or infra projects require huge funds. And by virtue of restricting the pledging or encumbrance of the securities, a hurdle was being felt that was not these companies were not in a position to raise the funds, requisite funds. So accordingly, it has been decided that 1 and 2 will be allowed to uh, leverage and to borrow against the securities of these companies. Next. Another important aspect which has been brought in is that the AIFs, their managers, and their KMPs have to conduct thorough due diligence on the investors and the investments they are making. The prime objective behind this is that the concerned AIF should not circumvent any of the financial regulations, and for the purpose of this due diligence, specific implementation standards will be developed by industry forums in consultation with SEBI so that any discretion can be avoided and a clarity and consistency can be maintained. Next. Now, with the tenure of any of the AIF schemes is generally 1 year. So, what would happen to the unliquidated investments of these schemes beyond after the expiry of the tenure? So, SEBI has decided that AIFs can now continue holding such investments in a dissolution period. So, in June 2023, SEBI had amended the regulations wherein they mandated for formulation of liquidation scheme frameworks. The object was so that the unliquidated investments are taken care of. Now, SEBI has decided that investments will be carried forward uh, according to the SEBI norms. A 1 year extension has also been granted for liquidation periods of the schemes with expired or about to expire periods. There would be certain conditions to it, but subject to the conditions, they would be allowed the extension. Next. So, yeah, there has been a small amendment in the InvITs regulations as well. So these funds InvITs will be allowed to privately place the InvITs to issue subordinate units as well. This framework will aims to address the valuation gaps between the sellers, that is the sponsors, and the InvITs, offering risk mitigation measures. This will facilitate bridging of valuation disparities between the sellers and the buyers, thus enhancing the efficiency in the InvITs transactions. So these were the brief amendments which have come up in the ICDR, LODR, AIF, and InvITs regulations. Over to you, sir.
Okay, thank you, Anjali, for covering this. Now I will request Ravi to take up the FPI Investors Regulation 2020, all the amendments which are there. Over to you, Ravi.
Very good evening, sir. Good evening, everyone in the audience. It was very enlightening to hear the updates and ease of doing business promoted by the various proposed changes that the SEBI will bring in. I will just quickly take up the issue of changes that are proposed in the FPI regime, in the ongoing current FPI regime. Number one is a proposal which has been put forward and would most likely reflect in the regulations that are going to come, is that the additional disclosures which were being made by the AIFs in compliance with the circular of August 24, 2023, and in view of the general obligations of an FPI enshrined under Regulation 22 of these FPI regulations, they have sought to exempt some additional disclosures based on a broader policy logic. So I'll try and explain that policy logic and where that exemption would be available. So this exemption is envisaged for those FPIs who have more than 50% of their India equity asset under management, not their global one, but only the asset under management in the Indian context, in a single corporate group, where the holdings are concentrated in a listed company with no identified promoter, if two conditions are met. Number one is that such FPIs should not hold more than 50% of their India equity asset under management in the corporate group after excluding their holding in the parent company. So therefore, they have to ensure that the concentration of holding is not exceeding 50% by not without considering their investment in the parent entity or parent entity of that particular group. And that parent entity should be one which has no identified promoter. This is only with respect to those companies where there are no identified promoters. And then second is that their holding in that parent company, if they are exceeding the 50% concentration criteria, then their cumulative holding of all branches of that FPI operating in India should be less than 3% in that parent company. Then the additional disclosures, as are envisaged in the circular of August 24, 2023, are then relaxed. Then there is a very welcome change regarding the timelines of the disclosure, regarding the material changes that FPIs encounter in the course of journey. You see, because these are regulated funds, anything that has an impact on their registration has to be necessarily reported to the SEBI or the designated depository participants through that route on immediate basis. Till the time this board meeting was held, all such information was required to be disclosed within 7 days of some events occurring or gaining knowledge about some events. Now a categorization has been sought to be done, and which that categorizes it into type 1 informations and type 2 informations. So I believe that type 1, which has got comparatively more stringent reporting timelines when paired with type 2, would contain those material changes which has direct bearing on the integrity of the securities market, interests of the investors, or the registration conditions of the FPI itself. And then the others would be in type 2. So now the revised timelines are for type 1, they have to make disclosure within 7 days. But any supporting documents for that disclosure, the window is provided, and that's where really the ease of doing business will be promoted. 30 days window have been provided that you make disclosure within 7 days without worrying about compiling and collating all the data. And the data could be supplied as a follow-up within 30 days. And for type 2 information, the window is of 30 days. So that's the other ease of doing business measure taken by SEBI through this board meeting. Now, the next and last regarding FPI is that a huge problem was faced, and this was an industry concern, that they were not feeling flexibility in selling their security, in dealing with their securities, particularly disposing them off in the event of expiry of their registration or due to any issue which arises regarding their status in their home country in regard to the FPI, the concerned FPI. So now what has been done is, Shivam, could you please take us to the next slide? So now, wherever FPI registrations that expire due to non-payment of registration fee, they are provided with a window to reactivate the same within next 30 days of such expiry. In this 30 days, they may also dispose of their securities if they do not wish to re-register or recuperate their registration as FPI. If they do not choose to liquidate or deal with their securities or dispose them off within the 30 days window, then an additional 180 days time has been provided for disposal of securities. Even if these 180 days time gets lapsed due to any reason, there is still a window for dealing with securities by FPIs, provided that there will be a 5% financial disincentive on reaching the first 180 days window, going beyond that in dealing with your securities. And this is when the FPI does not have registration, either due to issues in the home jurisdiction or change in compliance status, or due to failure to submit their reclassification papers. And after this 180 plus 180 days window, which totals to 360 days, now it has been provided that it will be deemed written off by the FPI concerned if they don't deal with it, their securities on failing to register or failing to continue to register as FPI. They can't. Their securities will be deemed written off post 360 days window. So clarity has been given, because there, to my knowledge, there are few issues where some FPIs have got these kind of problems due to their involvement in some market fraud activities. The allegations were leveled, in some cases proven also, and due to other regulatory issues of their own jurisdiction, they have got their securities not only undealt, but also under freeze of regulators in India. Now, it will be interesting to see how this interplays with those situations where those funds are being locked and lying idle. What steps they can take, it is for them to see. And more clarity will come once these are put down into the regulations as changes. That's all, sir, on the FPIs through this board meeting.
Okay. Thank you, Ravi. Thank you very much. Now, Anjali, you want to add anything else? Then I can go to the question answer. You are on mute, Anjali.
Sorry, Hanji. Yeah, we can start with Q&A. Anything would be there, we'll accordingly take up.
Okay. Now, first question is, when company has already approved approval of the scheme, ESOP scheme. However, it has not granted it to any employee. When should the in-principle approval be obtained? So, friends, before granting, the company should obtain in-principle approval from stock exchange. So, before granting, you have to take approval. Okay, Anjali?
Yes, sir. That as per the SBB regulations, one need to have in principle approval in hand before any grants.
Okay. Now, LODR regulation, kindly draw more light on the change made in promoter contribution. Anjali.
As per the present ICDR regulations, uh, 20% of the issue size has to be brought in by the promoters by way of minimum promoters contribution. But it had been observed that there are certain cases wherein 20% of post-issue holding is not there with the promoters. So now the question mark came in as to how to comply with this regulation as to minimum promoters contribution. So SEBI already has allowed 3-4 categories of investors, wherein AIFs, foreign venture capital funds, commercial banks, insurance companies are there, which are permitted to be counted towards promoters' contribution without being classified as promoters. So, adding to this list, they have now allowed any of the shareholders who are holding more than 5% of the shares in the company to be counted towards the minimum promoters contribution.
Okay. Okay. Now, what is the meaning of average of the 6 months period ending of 31st December amendment LODR? And this question is another question is, how will average market capitalization for 6 months ended 31st December be calculated? Whether it will be based on monthly, daily, or weighted average?
Sir, I think this will be better clarified when the amendment comes in, whether it will be simple average during last 6 months or it will be volume weighted average. Whenever the amendment comes in, a better clarity would come from there.
Let me just clarify, because
Yeah.
the member of this. Now, friends, what happened? The market rumor and various other things is connected to the market capitalization. That what is the market capitalization, on that basis that company are coming to that category. So the 31st March was the cutoff date, that 31st March market capitalization they will calculate. Now suppose a company's market capitalization is 10,000 crore on 31st March or 31st March normally, which we are calculating. And during that week, during that particular month, it has reduced to 8,000, 9,000, or the drastic fall down of the market, and it has gone down. So the issue came that 31st March it is up, but during the majority period it was less. So what will happen? So there are two things has come out. That first is that it will not be calculated on the basis of 31st March. There will be average market capitalization of 6 months. So 6 months means December and then July. These are the two dates they will calculate, and average they will take. And then another aspect they have taken, that a sunset clause of 3 years for cessation of the applicability of market capitalization based provision is also being introduced. So sometime market is going up and down, and capitalization is going up and down. So they are saying the non-applicability will be there if continuously 3 years something is reduced, because sometime the 10,000 is there, then 11,000, then 8,000, 7,000, then again 10,000. So they have calculated on the basis that continuously 3 years it is less than 10,000. Suppose the cutoff market capitalization is 10,000. So 1 year is 9,000, then 8,000, 7,000. So all 3 years it is less than 10,000. So that company will go out. But if a company has 10,000, then 8,000, again 11,000, and again this is 9,000, then because 1 year it has touched 11,000 and more than 10,000, so it will not be out. So two things, this is one. And second, the most important thing is 31st March is not the it should not be the criteria. It should be 2 times it will take place. But the question which is there, whether say is based on monthly, daily, and weighted average, that we have to see when SEBI will come out with the between the thing. But most probably that is on the weighted average, because the market capitalization, if you are coming out, they are coming out with scientific way, so it will be on the basis of weighted average, and weighted average will be on the basis, because now BBAP is also available. So daily average can also come. The way they are calculating closing price and opening price, and then the final price. So weighted average market price concept will be there. So daily calculation will also not be a problem. So they will work out, but we have to wait what SEBI is approving, that is not there in their guideline. Okay, Anjali, please elaborate on time extension of KMP appointment and likely affecting date of implementation.
Likely date of implementation will 99% be the date of the amendment coming in the official gazette. And otherwise, the impact thereof is primarily for the companies or PSUs which require any regulatory approval for appointment of KMPs. Government agencies, government companies especially, they require the ministry's approval before appointment of a particular person as a KMP. For them, it's the most important provision.
Okay. Can board meeting intimating be did before 2 working days?
No, I didn't get it.
The question is, can board meeting intimation be did before 2 working days? Somebody saying
Yes, it is minimum. It is minimum.
So I can give 7 days out also advance. Okay.
Yeah.
So 2 working days is minimum, but I can give
It
3,
can
4,
be
5.
more
There's
than.
no restriction. But I cannot be less than 2. Okay. Explain market cap provision, particularly 3 criteria that I have explained. My question is, Ravi, my question is regarding the foreign portfolio investor regulation. If any FPI is holding 100% of its equity investment in our company, and we have received an email from NSDL that they have not given the disclosure, what has to be done on part of the company?
The company cannot really take any action to a positive or an enforcement action to direct the FPI to divest. But surely, if NSDL has written an email, the company must fairly disclose the position of the FPI in the company, the holding on fully diluted basis, as well as if there are any convertibles. The only thing company can do is to provide all cooperation to the NSDL. And if at all it is seen as a governance issue by the company, they may also report it to the custodian as well as the exchange, as well as the SEBI about the same.
Okay. So you mean to say that they have to inform to the stock exchange. The stock exchange they can't take their own action.
They can't take their own action because it's an investor is being holding the securities. They can't really enforce it.
Anjali, in case stock exchange impose SOP fine under LODR, it is required to be disclosed.
Yes, sir. As per the Schedule 3, it is needed to be disclosed.
The company has to restrict the voting right. Ravi, this is continuously, the company has to restrict the voting right if that is not disclosing.
Drawbacks of laws, they are directed to divest in case they do not. The norm is that either you make disclosures or you divest, you come down. If they don't do any of this, that also can be done only once you receive. It will not be safe to suo moto go and freeze their voting rights because every share has to carry a voting right. That's the mother law says so, Companies Act. So unless until you have a regulatory direction, a clear direction, don't go for suo moto freezing the voting right because the time when you have to freeze it should also be come out with clarity.
But Ravi, suppose they are not doing this, I can restrict their voting right.
Certainly, seeking advice of NSDL first and then taking that measure. But they must take confidence. They must take NSDL in confidence if they are communicating with NSDL on that subject.
Okay.
Not unilaterally, because then it will depend. Suppose a disclosure is only delayed, then and some important issue is there. Restricting voting right could be a nuisance that could be played out, and it will also jeopardize the corporate democracy. So therefore, this being a very crucial decision, whether to suspend the voting rights of a shareholder, they must take NSDL in confidence before.
And then he's asking how it can be done. So they have to report to the, I think, through depository they can work out.
Yes, through designated depository participant, they can work out. But in the query, since you mentioned that they have already received a communication from NSDL, they should they should correspond with NSDL and figure it out as to what all their queries are. And then also they may also suggest it to NSDL that we can freeze if you direct. I mean, we can take measures that you will direct. Possibly freezing of voting right is one of the options that is available at the behest of the company.
Okay, Anjali, please elaborate on time extension for KMP appointment and likely affecting date of implementation.
Sir, we have discussed it.
Maybe even then he's asking again this question. Repeat it.
So impact is any appointment which requires the approval of any regulatory authority or statutory authority. Only in those cases, relaxation would be granted. But in other cases, it is 3 months is 3 months. Implementation date would be whenever SEBI comes out with the amendment.
Okay. Ravi, the same question, the person is asking, the company has received the email for restricting the voting right, but the Companies Act does not allow the right to be restricted.
They must look at the circular which was issued by SEBI on 1st of November 2023 regarding FPI regulations. There is a provision of restricting the voting rights in case there is a continuous non-compliance regarding beneficial ownership disclosure. And now, since NSDL is asking them to freeze the voting rights, this could be a possible non-compliance on part of the company to not adhere to the instructions of NSDL, because NSDL is a market infrastructure institution. It is the first line of regulator. So
Okay.
It must be reasoned out with the NSDL, and surely this is not in non-compliance of Companies Act. Unilaterally, if you do it, it's a non-compliance. It could be non-compliance, but there is a provision of freezing. Since NSDL is saying so, they can go ahead with it.
Okay. Anjali, can you elaborate on deemed write-off of security if securities has not been disposed till 360 days?
I didn't get, just a minute, sir.
ये किसका part है ये? This is this amendment.
No.
So
Deemed write-off of securities if securities have not been disposed of till 360 days.
Drishan, please explain it clearly. You are referring about this a particular circular or some other thing, so we can give answer.
I just wanted to clarify one thing, sir. I think by slippage, I said circular dated 1st November 2023. The circular is of 24th August 2023. It was effective from 1st November 2023.
Okay. How will the Anjali amendment of SEBI ICDR Regulation 18, particularly removal of 1% secret deposit requirement, impact companies planning IPO fundraising activity?
The 1% security deposit never acted as an impediment for fundraising. Any company which has to raise funds either by way of IPO or FPO or rights issues would still do it. But blockage of the funds for that much period, generally for 3 months, that was surely a procedural hurdle for the companies. Now, if this has been done away with, they would not be bothered about it. That's the reason why I said it's a company friendly move.
Okay, Ravi, this question is related to FPI. Can you elaborate on deemed write-off of security if security have not been disposed till 360 days?
You see, those will be as happens in case of a strike-off company. All the property and the assets of that company vests in the state, and this provision we have taken from the United Kingdom. So this deemed written off is that the ownership of all that securities, whatever is not disposed of by an FPI who continues to be unregistered and not recuperating that default, would be that on passing of 360 days, this will all vest with the designated depository participants or the system that they will make out in the regulations or the custodian, and they will then sell it off in the market according to the norms, and all of that money will go to the Investor Education and Protection Fund. This is what deemed written off means. It means it will be flushed out from the FPI's account.
Okay. Okay. Can you explain the implication of allowing promoter group entity and non-individual shareholder holding more than 5% of post-offer equity share capital to contribute towards minimum promoter contribution without being identified as promoter under amended regulation? I mean, what will be the impact of this, and have you seen some cases?
So majorly it would be for the startup companies and new age companies which have to come out, which come out with IPOs, because therein, as I said earlier, many a times because of multiple rounds of fundings, the promoter holding in these companies is very small. So in those cases, earlier they were not in a position to come out with the IPOs because of this condition of 20% minimum promoter share contribution. And these companies generally also do not have AIF funding or venture capital funding, may not be having scheduled commercial banks funding, may not be having. So therein, but because they have done those rounds of investments, by virtue of which there may be investors, there would be investors who would be holding more than 5% in them. So those people would be allowed to be included in the promoters contribution, and these such companies can come out with the IPOs, which earlier they would have felt themselves to be unable to.
Okay. Anjali, regarding the SEBI AIF regulation amendment, what are the specific due diligence measures the AIF, their manager, KMP are now required to undertake on investors and investment?
Sir, these would be formulated by the industry forums in consultation with SEBI. But what we understand is that the people who are investing in this pool of fund that the AIF has created, those people should be people of standing credibility. There should not be any cases or any legal hurdles in them. And the investee companies should also have the same stature, should be the due diligence parameters which the AIF will have to undertake.
Okay, Ravi, now the three questions on AIF, FPI. What specific condition must foreign portfolio investor meet to qualify for the exemption from additional disclosure requirement as mentioned in the amendment of SEBI Foreign Portfolio Investor Regulation 2019?
Yes. Number one, it is applicable to those FPIs who have got 50% of their India equity AUM, assets under management, on the only India focused, not the global. In second is that all should be in a single corporate group, which means 50% AUM's more than 50% exposure in a single corporate group, concentrated in a listed entity with no identified promoter. If these conditions are there, then you have to comply with twin tests. One is that you should not hold 50% of your India equity AUM in a corporate group after subtracting the holding in parent company. So you remove the parent company and then you see whether you are holding your exposure as an FPI of your India equity AUM is more than 50% of the total AUM or not. If it is less than 50%, then you qualify this test. Second is that in the parent company which you excluded for calculating this 50%, you should not hold more than 3%. These are the twin tests.
Okay. How do the relaxation of disclosure timeline and the provision for reactivation of FPI registration post expiry enhance ease of doing business for FPI according to amendment to SEBI foreign regulation?
See, disclosures were of all sorts. I would say that till this time, board meeting happened and this prerogative, this policy change was effected, that we will now categorize the disclosures into two buckets. One with 7 days timeline plus 30 days timeline to provide supporting documents, and then the type 2 bucket in which you have 30 days to make disclosure. Everything was painted with same brush. In FPIs, they have got lots and lots of details about the funds that invest through FPIs, the ultimate beneficial owners. So it was really difficult for them to compile all that data and report it. And there are also cross-jurisdictional issues and cross-regulatory issues in all of this. So considering all of that, they have now rationalized the disclosure. They have said what is important and immediately consumable for the market. You disclose within 7 days. And then you send the supporting documents in 30 days. And whatever can wait, it can wait and come in 30 days. They say accuracy is more important rather than the velocity with which the information is flushed into the market. So I think that is the way they have rationalized it.
And if any FPI has invested in its whole investment in one Indian listed entity, then whether exemption available or not?
It is not, because it says 50%, more than 50%. Yes, it can be. It can be because it says more than 50%. So if more than 50% of their Indian equity AUM is being talked about, surely it will also include in itself 100%. But there is a regulation in FPI which says that they can't hold more than 10% of a listed security.
So when they are saying 50%, so it means there must be some restriction. Otherwise, they can say there's no restriction of any investment in any Indian company.
There are two things. One is that an FPI cannot hold beyond a certain threshold of paid up share capital of a listed company, which is 10%, which is set out at 10% currently. Their own pool of funds from which they are investing, if they are investing more than 50% of that pool in one corporate group and complying with the twin condition of not exceeding 50%, removing the parent company, and not holding more than 3% of paid up capital in the parent company, then they can avail these disclosures, exemptions.
Okay. Anjali, the rumor verification. Okay.
Yes, sir.
This is based on material price movement. Okay. Now,
Right.
utilizing an unaffected price for transactions subject to SEBI regulation if rumors are confirmed within 24 hours significant price shift. Now, requiring prompt response from KMP and verify. Now, prompt response, earlier they were saying within 24 hours, within 12 hours. Yeah? So what is the meaning of prompt? People will be confused.
So dictionary meaning ही use करना पड़ेगा as early as possible. So anything which comes to the noting of a particular person, a particular KMP, has to be responded ASAP. We cannot say that I've got to know of this at 10 a.m. today. I'll be responding only at 9 a.m. tomorrow. If I've got to know at 10, that means it's my responsibility and duty to inform it as early as possible. At the earliest, basically.
There is another thing.
Before it does any harm. Sorry, Ravi?
I would just add one more thing. This is a nuanced way of looking at it now. As soon as possible, as you rightly said, could it also include the concept of as soon as practicable? Because there could be few information which I got knowledge of at certain point, but it needs some more, fine-tuning and needs to become more concrete, or at least I need to ponder over it when to disclose. So would that also be, would prompt means as soon as practicable, or it is only...
Ravi, now they came out with 12 hours, 24 hours. So that means that you have to do this. Now what I'll do, I will say I got the information, but I was verifying.
Verifying, correct.
And the verification has taken place 3 days.
Yes.
But if there is a timeline of say 24 hours, then mean I got the information and I'm verifying within 24 hours and submitting it.
Correct.
I'm just saying this particular thing, SEBI has to give some example that on normal cases, it should be within 24 hours and rest of the things which you have to verify immediately as soon as possible.
Because there is no reverse burden on this.
Yeah, otherwise entire will come on your file. Anjali, the specify the unverified information from media source does not constitute generally available information under SEBI insider regulation. Okay. So, yeah. So they have.
Yeah, sir.
Earlier there was an issue that all rumors, verified, non-verified, verified source, non-verified source. So they want to tell that you have to give information on the specific point, not the generally verified routes. What is your view?
Sir, in addition, no, I think what SEBI has clarified is presuming a news comes, a rumor or whatever comes in online that company A is merging with company B. You don't verify it, you don't deny it as a company, but one month down the line, actually that transaction is happening, and you do some transactions, some share transactions in between. So tomorrow you cannot say that since that news was there 1 month back in the newspaper or in the online media, I did the transaction because it was a generally available information. It is still a UPSI till the time it has not been disclosed to the market at large through a verifiable company source. It is still a UPSI, and you cannot trade on the basis of that information, saying that XYZ paper had published it or any website had published it.
Okay. So I think Ravi, this question which FPI issue was there, he's asking one more thing. I'm just repeating, if any FPI has invested in whole investment one Indian listed company, then whether exemption available or not, but the company has identifiable promoter, then.
No, it cannot. If
Yeah.
promoters are identifiable, this is one of the condition. This was the fourth condition that I read out as a precondition to avail this exemption. Promoters should be not identifiable.
Okay. Okay. So I think the another question which I have just now received, Anjali, this is for what is the difference between differential factor for all these AIF categories?
The difference between AIF categories. There are many differences, but the most important which I would may cover here are the type of funds which can be covered in each of these categories, and also the purpose for which these are created. For example, category 1 can invest in startups or social venture funds, social venture enterprises. Category 2 cannot invest in startups. Category 3 can use complex and hybrid investing strategies. They can invest in derivatives, while 1 and 2 cannot invest in derivatives. So this is with regard to the objects. Then likewise, SEBI has identified the type of institutions which can be categorized as 1, 2, or 3. There can be startups, there can be social venture funds, there can be infra funds can be there. 2 it can be private equity funds or debt funds. 3 it can be hedge funds as well. So all these are the reasons, and they can invest in only a particular type of investee company. These are the broad difference if I cover, but otherwise there is a lot of difference between entire 3 range.
Okay, this is the basic difference which you have mentioned.
Yeah.
All our organization can be categorized as AIF. What all organizations can be categorized of AIF?
That's what I've mentioned, sir. That's what I've covered.
Okay.
Yeah.
So various people are asking PPT that we will share. Now, Shivam, are your polls are ready? Because we conduct polls in every webinar. So I'll just request Shivam to just display the polls which you have asked from the audience. So first is regarding the launch of beta version of optional T+0 settlement. Do you think it will improve liquidity and efficiency market? 77%. Increase market volatility 17%. Have no significant interest 6%. Okay, next. Regarding amendment of ICDR, which change do you find most beneficial to companies coming out with IPO fundraising? Doing away with the requirement of 1%, 43, allowing promoter group entity and non-individual, 33, including equity share resulting from the conversion of convertible instrument, 13, increased flexibility in extending bid offer closing period, 10%. So 1% security deposit, it's people are thinking, but I think the second, second allowing promoter group entities and non-individual, that is the most important, because 1% security deposit, no doubt that's a money which are stuck, but for long-term growth, these are the people, those who have no identified promoter, they are recognizing this. Next is, do you support the flexibility provided by category 1 and category 2 AIF to create incumbents to their holding of equity in infrastructure sector investor companies? Yes, it will facilitate capital raising for infrastructure projects, 62. No, it might increase financial risk and unsure, 36%. Next, regarding amendment of SEBI LODR, which change do you think have the most positive impact on listed company? Market capitalization compliance based on 6 months, 29. Extending timeline for filing vacancy of KMP, 24. Harmonization or reduction of timeline or prior initiative of board meeting, 37%. Increasing the maximum permitted time gap between 2 meetings of risk committee, that is 10%. So no doubt 29, that market capitalization concept is very, very important. That is there. And second, also very important point. Shivam, do you agree with the introduction of objective criteria for rumor verification by listed entity? Yes, it will enhance market integrity and reduce speculation, 71. No, 5%, and unsure, 24%. Do you support the additional disclosure requirement exemption for certain FPI? Yes, it will reduce regulatory burden and encourage foreign investor to join more, 61. No, it might compromise transparency, 20%, unsure, that is 20%. So friends, these are the questions. Now that the topic was small, and the whatever questions everybody has asked, we have taken. So it's a time to close. Normally we are overshooting time. This is the my memory. This is the first time that our session is finishing at 1 hour 30 minutes. But I want to just inform you, which I have informed in the beginning. Our next webinar is 166th, 7th webinar on small and medium REITs. And that is very important because SEBI is coming out small and medium REITs and for income generating and completed properties, which may include commercial assets, renting house, warehouse, and hotel, and among others. It is a game changer and it will bring out more fund, more things. And this will be a very interesting program, and maybe it is a new concept, so people may not feel that it is something great for them, but actually future belong to this InvIT REIT and AIF. So please join this. Till then, thank you very much to all. Thank you, Anjali. Thank you, Ravi. And thanks all participants for joining us.
Thank you, sir.